What do you see when you look at this picture? You probably see the normal apartment building in Dubai, right? But I see 3 red flags that indicate you should avoid investing in this property. Ability to notice them is what differentiates those who earn huge profits from real estate and those who make nothing. I'm Jay Abrams, former management consultant and banker. And now I help investors make data-driven decisions in UAE real estate market to achieve great returns. In this video, I'll tell you about 7 red flags to avoid when investing in Dubai real estate. Starting with red flag number 1. Location that's not growing. Everybody knows that real estate is about location, and the location should be growing. And not growing in size or number of buildings. We mean growing in value. But there is something most people don't realize. They confuse an artificial price increase with actual growth. Let me explain. Look at this graph showing average price growth in Dubai Marina. It looks like there was a huge leap from 2021 to 2023 with 65% 2-year growth. And then prices went down a bit, decreasing by 9% in 2024. So it might create an impression that if you bought an apartment for $1 million in 2021, now it would cost $1,540,000 But that's not true. The rapid growth in 2022 and 2023 came from new building launches. For example, one off-plan building that was selling back then was priced 5 times higher than the market average, and the developer sold 1,000 units at that price. So these and other similar launches affected the statistics significantly. And when we remove off-plan from this graph and leave only secondary market deals, the picture is quite different. Looks like the properties in Dubai Marina were steadily growing in line with the market, without any leaps followed by declines. This approach isn't perfect, but it's good enough for general area analysis. And when you apply it and see areas like this or like this, you should stay away from them. Often you should stay away, but not always. Because what really matters is what will be going on in the area in the near future. Take Maritime City, for example. The growth for the last couple of years was bad, but the area now is just one building and nothing else. In a few years, there will be a Beyond Omniyat master community. Many high-end buildings, including ultra-luxurious ones in collaboration with Dorchester. And there will be a private beach. So what might have seemed like a red flag from the initial analysis turned out not to be one. But I can't say the same about the next red flag, because when you see an area like this, it's a no-go for sure. Red flag number 2. Low rent-to-price ratio. And of course, this is for someone looking for a rental property. Rent-to-price ratio of an area is basically what it sounds like. You get it by taking an average rental rate and dividing it by the average price of the property. It's not a yield, because it doesn't take into account operating expenses. But this is something you look at to quickly assess if the rental property is worth it. So the average rent-to-price ratio in Dubai is around 4 to 5%. You can find plenty of areas where the average is 6, 7 or even 8% for certain types of properties. But sometimes you stumble on examples like this. Here is a real Dubai area. The average rent in this neighborhood is $24,500. This is not the listing price, but the real transaction rate. The average apartment price in the same area is $900,000. Again, transaction price. So we divide the first number by the second one and get a 2.7% rent-to-price ratio, which is a red flag for a rental property, since it's significantly lower than the city average. Just to check ourselves, we do this exercise for different apartment sizes, and it doesn't make any difference. Still, the rent-to-price ratio is low. Now one might say that the area will change, there'll be so much more demand, and the rental prices will go up. You still shouldn't go for it. First, rental prices would go up that much only if the changes were dramatic, like desert turning into parks, shopping malls and schools. Big changes. And it happens, but you should be absolutely sure that this is the case with the area you're analyzing. Second, purely mathematically, for one bed in this area, the rental rate needs to increase up to $36,000 per year to get a 7% rent-to-price ratio. Compare it to other areas to see if it's reasonable. That's pretty much like Creek Harbor, and 2 times higher than the average in GVC. Third, Even if you believe that changes will make the area very attractive and rental prices will indeed double, why take such a high risk? Usually, rental property investing is done to secure a stable source of income, and you have an alternative of investing in an area with a much higher rent-to-price ratio right now. But even if the area is growing and has a good rent-to-price ratio, there can still be red flags related to the developer. So let's do a quick rundown of the signs you'd better watch out for. Red flag number 3. A history of big delays. 2 important notes. First, any developer, even the best ones, can have delays. It just occasionally happens for various reasons. And it's alright if the delays are rare and not too long. If you wanna buy only from a developer who has 0 delays, then you'll probably find someone without much history on the market. Second, we had some clients who don't think that a delay is a problem, especially those who are stretched with a payment plan and wouldn't object if they could pay the outstanding amount later, even if it means getting the unit ready later. That said, delays significantly affect your investment case, especially if you're going for a rental property. And revealing the delay's history isn't hard, but there are some things to pay attention to. A. What was the initial expected date of completion? Because sometimes it looks like the construction progress took too long, but that's what investors knew from the beginning. For example, Opus by Omniat was built over about 9 years. But that was the plan initially. B. Sometimes you see that a certain developer finished the construction significantly later than planned, but initially another developer started the project. For example, in Dubai Marina, there was a project called Pentaminium, which began in 2008. 3 years later, construction stopped. And many years after that, Select Group bought the plot at auction and rebranded the project into Six Senses. It might look like Select Group has been building it for more than 15 years, but in reality, they just started working in 2023. These and other red flags are much easier to notice if you have someone by your side with strong expertise and data-driven approach. And if you need this or any other kind of help with investing in Dubai real estate, reach out to my team. We'll help you select the right property based on your investment goals, analyze every aspect of it, secure the unit, and support you throughout the whole process. We handle everything end-to-end, completely free of charge. So call or WhatsApp us, scan the QR code, or click the link in the description to get a free consultation with my team. And one of the red flags my team will help you reveal is red flag number 4. Bad performance compared to the market. If the developer consistently performs worse than the market, the chance that now is gonna be different is quite low. But the mistake that many make is choosing the wrong market for comparison. Look at this graph. It shows the average price per square foot for a certain developer's villas and townhouses in secondary market deals. Since 2021, the average price per square foot went up by 58%, which looks higher than the Dubai market average. That's good, right? But if we do one simple change and compare this growth pace with the average for villas and townhouses in Dubai, the outcome is different. The average villa and townhouse price increased by 69% since 2021, which makes our analyzed developer not that impressive anymore. So finding the right market for comparison is critical. And if the developer is building on the Palm, you'd better compare their performance with the average results of the Palm. But there are cases when you have just nothing to compare with. Red flag number 5. No history. It's not like you can't buy from a developer who's building the first project, but if there is absolutely no evidence of them doing a good job, then I wouldn't recommend investing. What might be the evidence if the new developer is likely to be good? First, their experience in other markets. If the developer previously built something in India, the UK, Spain or somewhere else, it means you have some data to consider. But please don't take everything at face value. Check if their projects overseas are of similar type, and if they have decent reviews, etc. Second, their work as contractors. Some developers in the UAE market start by doing construction work for other developers, so you can check what they deliver. But be aware that contractor can mean many things. If the company only provided a dump truck, They're technically a contractor, but that's not the same as building an entire project. Make sure that they've done a significant amount of relevant work. Third, background of the top managers. If the executive team of the developer consists of former top managers of other big developers, that's a good sign. Chances are they know what they're doing and wouldn't damage their personal brand by failing to deliver on their promises. However, just because the developer is great doesn't mean every project will work well. They're not necessarily bad, but not every project will perform great from an investment point of view. Red flag number 6. Low level of uniqueness. Let's say you're considering an apartment in a project in Business Bay. The area is not bad, other buildings nearby generate decent returns, and the developer is well known. But there is a problem. There are 1,000 apartments in this building. That's too much, because after handover, your unit will be very similar to the other 999 apartments. So you'll have absolutely no leverage when you try to sell or rent out. Okay, so maybe we need a low-rise building. How about this one? 10 stories and 230 units. That's 4 times fewer than the previous project. Sounds much better. Yeah, but this building is one of 70 identical buildings planned in that community, and 50 of them are scheduled to be completed almost simultaneously. In total, the project will have 16,000 units, 11,000 of which will complete with each other at handover. These examples are real, and we can see how such investments ended up for owners. Here's a chart showing price per square foot dynamics in a project with 70 similar buildings. 5 years after the sales launch, on handover, prices are almost the same as they were back then. But even if the project is quite unique, there is always a risk it's overpriced. And that's red flag number 7. And overpriced is such a vague term, so let's define what we mean by overpriced. A project or unit can be considered overpriced if another one by a similar class developer, in a similar location, and of a similar type, meaning similar size, views and layouts, that's available now or was recently available, is priced cheaper. And don't forget the payment plan. It should also be considered. But finding comparable units with all these criteria is usually challenging. Some have unique locations. Some are surrounded by very different developers. So let's make a tweak to make the analysis easier and the red flag more visible. The question we ask ourselves is there a better investment for the same money? Let's put this into practice. This is Dubai Islands. And say you're looking for a property with the best value appreciation potential. There is project A in this spot. The building is nothing special. Standard amenities and is a 10-minute walk from the beach. A one-bed with no views is $610,000, which is $680 per square foot. For a slightly lower price of $580,000, you can get a one-bed in another project. It's located within the same walking distance from the beach, but it comes fully furnished, is bigger in size, and the developer has a better reputation. Here, price per square foot is $550, indicating that the project A is overpriced. Let's do a sanity check and compare more. Project C is $700 per square foot, and this developer has at least 2 red flags: previous performance and delays. Project D is cheaper at $530 per square foot, but it has another red flag: no history. So, on the surface, it seems Project B is quite well priced, which means you can go deeper and analyze its various aspects to decide if it's worth it. And this is exactly the exercise we do on this channel for the most interesting launches on the Dubai real estate market. You can check one right here.